G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, I'm going to be providing a business update for Seritage growth properties, and we're going to be going over some of the latest developments. So in particular, we're going to be looking and talking about the upcoming shareholder meeting. We're going to be talking about the liquidation and the process that will be happening when it comes to selling all of Seritage growth properties assets and then returning the cash to shareholders. We're going to be talking about the Sears litigation. We're going to be talking about potential risks with this investment and then also the potential rate of return. So if we go into a bit of a timeline of the events, in March of 2022, Seritage Growth Properties announced that the company would undergo a strategic review of alternatives which could potentially enhance shareholder value. And a few months later, on the 7th of July, they actually came out and announced that they wanted to liquidate all its assets either through a single buyer or merger or by selling groups of properties as well as properties on an individual basis. So in other words, they want to liquidate all their properties. And then on the 16th of September, just a few days ago, SRG announced the annual shareholder meeting will be on the 24th of October. And within this meeting, the shareholders will be able to vote on whether they say yes or no to liquidating the rest of the business. So what happens next? Well, the first thing that will need to happen is the proposal to sell all of SRG's assets will need to pass a 2/3 shareholder vote. And the good news is that Eddie Lampert, who owns almost 30% of Seritage Growth Properties, has already agreed to vote yes. The second thing that will need to happen is obviously Seritage will have to start selling their properties, but they'll also have to pay back $1.44 billion in Berkshire debt. They'll also need to pay out Series A preferred shares, which is about 70 million. They'll also need to pay dividends on these Series A's preferred shares up until these preferred shareholders have been bought out. They'll also need to pay fees and expenses related to the asset sales. They'll also need to pay the ongoing operational and wind down costs. Obviously, they're still a business and they still have business expenses. And then also they'll need to pay capex for property prior to disposition. So when will we be paid and how much? So they've announced that they expect to pay shareholders in the range of between $18.50 and $29 per share, and is estimated that the process of selling all the properties, it'll take about 18 to 30 months after the plan has been approved. And we also got an update in the latest proxy statement that the Sears litigation has entered agreement for settlement, and this settlement is going to be approximately $35 million or 0.62 per share. So what are some risks? Well, there's a risk that the vote is rejected. Obviously, if the vote is rejected, then the assets won't be able to be, or the company won't be able to be liquidated. Another major risk is that the distribution size and the timeliness of selling all the properties is not guaranteed. So, for example, the undeveloped properties or the properties currently under construction could be harder to sell. There is also market risk. So, obviously, higher interest rates. This is going to push down the selling price of some of these properties potentially. And we've actually got some news recently from the latest proxy statement that due to the tough macro conditions at the moment, management have warned that the payout will likely be on the lower end of guidance. So it's probably not going to be up near the $29 per share. They're saying it's more likely to be around the $18.50 per share. But at least the Sears litigation will be settled. So at least in that aspect, in terms of litigation, this is no longer a risk that can sort of hold up the payment of the payment back to shareholders. And so if we talk about potential ROI, well, the stock is currently at $11 per share. And if we use the high end of the time estimate for liquidation, which is 30 months or 2.5 years, and we use the low end of the distribution value, which is $18.50 per share. So if you were to buy at $11, that would give us a return of 23% per year. And obviously this return would go out for over the next 30 months. So pretty much what you're looking at here is, if they hit the high end of their time estimate and then the low end of their distribution, you're looking at a 23% return, which is, very solid. Obviously, there is a chance that if the macro continues to deteriorate, the low end of this, distribution, it might drop below 18.50. There is a risk there. Look, there's no real way of knowing what's going to happen in the macro. The company in the proxy statement did say that if they expect that they will be below this low end of the distribution range, they would release an updated proxy statement prior to the vote of what they think they could, sell all the assets for. But essentially, guys, this is what we're looking at for this investment as it stands with the current information that we have. Obviously, we need to watch out for these risks. There's a chance the vote could be rejected. There's a chance that these properties are harder to sell than expected and that they don't sell them for as much as expected. But guys, thanks for watching. Make sure you like this video and subscribe to my channel, and I'll see you in the next one.